Let me ask you something. What if I told you that the strategy your financial advisor, your CPA, your smart coworker at the office has been calling tax-free, the one you've been bragging about at dinner parties, is quietly costing you money in taxes you had no idea you owed? What if the very move you made to avoid taxes is actually triggering a tax bill? And what if almost nobody is talking about this because, honestly, most people don't even know it's happening to them? I'm Dr. James, your money advisor, and today we are pulling back the curtain on one of the most misunderstood strategies in all of personal finance, the Backdoor Roth IRA. Now, before you click away, thinking you already know this one, stay with me, because what I'm about to walk you through is not the basic, here's how to do a backdoor Roth video you've seen 100 times. This is the part nobody tells you. This is the part that shows up on your tax return and makes you go, wait, where did this come from? So if you have ever done a backdoor Roth, or you're planning to do one, or someone told you to do one, you need to watch every single second of this video. All right, let's start from the top so we're all on the same page. The Backdoor Roth IRA is a strategy that high-income earners use to get money into a Roth IRA, even when their income is too high to contribute directly. See, the IRS puts income limits on who can contribute to a Roth IRA. For 2024, if you're a single filer making over $161,000, or a married couple filing jointly, making over $240,000, you're phased out. You can't just walk up to Fidelity or Vanguard and put money directly into a Roth IRA. The door is closed for you. So what do people do? They use the back door. They make a non-deductible contribution to a traditional IRA because there's no income limit on that. And then they convert that traditional IRA money over to a Roth IRA. And because they already paid taxes on the money going in, the conversion is supposedly tax-free. Simple, clean, beautiful, right, wrong. And here is exactly where things go sideways for so many people. The mistake people make, and I mean really smart people, doctors, lawyers, engineers, and business owners, is that they hear non-deductible contribution, and they automatically assume that means no taxes on conversion. And in a perfect, isolated world, where that's your only IRA, sure, that logic kind of holds. But we don't live in that world, and the IRS does not care about your neat little mental accounting system. The IRS has a rule, and it is called the Pro-Rata Rule, and it is the reason your tax-free backdoor Roth isn't always tax-free. Here is how the Pro-Rata Rule works, and I want you to really pay attention here, because this is the part that gets people. The IRS looks at all of your traditional IRA money, every single dollar sitting in every traditional IRA you own at the end of the year. It doesn't matter which account you converted from. It doesn't matter if you opened a brand new IRA just for the backdoor strategy. The IRS treats all your traditional IRA balances as one big pool, and then it figures out what percentage of that pool was made up of pre-tax money versus after-tax money. And that ratio, that pro-rata percentage, determines how much of your conversion is taxable. Let me give you a concrete example because numbers make this crystal clear. Say you make $250,000 a year. You're over the income limit. So you decide to do a backdoor Roth. You open a new traditional IRA. You put in $7,000, the 2024 contribution limit. You don't take a deduction on it because you can't at your income level, and then you convert it to a Roth. You're thinking, I already paid taxes on that $7,000, so the conversion is tax-free. Makes sense, except, and here's the problem, you also have a rollover, IRA, from an old 401k sitting at your brokerage with $93,000 in it. All of that $93,000 is pre-tax money, so now the IRS looks at your total traditional IRA balance, $7,000, after tax plus $93,000 pre-tax equals $100,000 total. Your after-tax money is only 7% of that total. So when you convert that $7,000 to a Roth, only 7% of it, that's $490, is considered tax-free. The other 93%, which is $6,510, is taxable income. You owe taxes on $6,510. At a 32% federal tax bracket, that's over $2,000 in taxes on a move you thought was completely free. Do you see how that works now? That rollover IRA, that's just sitting there, minding its own business, doing nothing. It just torpedoed your backdoor Roth strategy. And here is the brutal truth. Most people who do backdoor Roths have old 401k money rolled into traditional IRAs. It's one of the most common things people do when they leave a job. Roll your 401k into an IRA. Totally normal, totally reasonable. But it completely destroys the effectiveness of the backdoor Roth strategy if you don't know about the Pro-Rata Rule. And it gets even more nuanced than that. Some people find out about the Pro-Rata Rule, and they think, okay, I'll just move my rollover IRA back into my current employer's 401k, then do the backdoor Roth. And honestly, that can work. But only if your current 401k plan accepts incoming rollovers from IRAs, which not all of them do. You'd need to check your plan documents or call your plan administrator. Some plans are very flexible, some are not. So that's not a guaranteed escape hatch. It's an option worth exploring, but it's not automatic. Now, there's another thing I want you to understand that adds yet another layer to this. Some people do the backdoor Roth perfectly. No pre-tax IRA money anywhere. They've cleaned everything up. And they still mess it up. How? Timing. Here's what happens. They make their non-deductible contribution in January. They let it sit in the traditional IRA for months because they read somewhere that you should wait a bit to avoid the step transaction doctrine, which is a whole other IRS concept we'll save for another video. And while it's sitting there, the money earns a little bit of investment return. Maybe it's $50, maybe it's $150, doesn't matter. That little bit of gain is pre-tax. It's earnings. And when they convert the full amount to a Roth, that small amount of earnings becomes taxable. It's a small number, sure, but the point is, even in a clean, isolated situation, there can still be a taxable component if you're not paying attention. And let's talk about the Form 8606 situation, because this is where I see people lose actual money through pure administrative mistakes. When you make a non-deductible IRA contribution, you are required by law to file IRS Form 8606 with your tax return. This form is how you keep track of your basis, the after-tax money you've put into your traditional IRA. If you don't file this form, the IRS has no record that you already paid taxes on that money. So when you eventually convert or withdraw it, they could tax you on it again. Double taxation on the same dollars. And the scary thing is, this happens more than you would think. People switch CPAs. They do their own taxes one year. They forget. The form doesn't get filed. And suddenly their basis tracking is a mess. Reconstructing years of Form 8606 history is a headache you do not want. So if you are doing backdoor Roths every single year, make sure that form is being filed. Check your tax returns. Verify it's there. Don't assume your accountant is handling it without confirming. I also want to address something I hear all the time in the comments and from clients. People say, Dr. James, I heard that if I just convert the money the very next day after contributing, I'll be fine. And look, the next day thing is popular advice, and there's a reason people say it. The idea is to minimize the time the money sits in the traditional IRA, earning taxable gains before conversion. That part is valid. But the next day conversion does absolutely nothing to solve the pro-rata problem. If you have $200,000 in a rollover IRA and you do a next day conversion, the IRS still sees that $200,000 when they calculate your pro-rata ratio at year-end. The timing of the conversion within the year does not change the year-end aggregation rule. Please do not let anyone convince you otherwise. So what should you actually do? First, before you do a single backdoor Roth, take inventory of every traditional IRA, SE, PIRA, and simple IRA you have. Add up all the balances. Figure out how much of it is pre-tax versus after-tax. If you have significant pre-tax balances and no way to move them into a 401k, the backdoor Roth math may simply not work in your favor. It might be worth doing with the taxes factored in, or it might not be. But you need to run those numbers with clear eyes, not with the assumption that it's free. Second, if your employer plan accepts IRA rollovers, seriously consider consolidating your pre-tax IRA money back into the 401k before doing the conversion. Third, work with a CPA or financial advisor who actually knows what Form 8606 is and files it correctly every year. Not everyone does. And fourth, never just execute a strategy because it sounds good. Always model out the actual tax consequences before you move money. The backdoor Roth is a legitimate, powerful strategy when used correctly. I'm not here to scare you away from it. I'm here to make sure you go in with your eyes open. Because the difference between a well-executed backdoor Roth and a poorly executed one isn't just theoretical. It's real dollars on your tax bill, year after year, that you didn't budget for and didn't have to pay if you'd just known the rules. This is exactly why I say it over and over on this channel. Financial strategy is not about knowing the name of the move. It's about knowing every condition under which that move works and every condition under which it doesn't. The backdoor Roth sounds like a loophole. And in a narrow set of circumstances, it kind of is. But the IRS isn't asleep at the wheel. The Pro-Rata Rule exists specifically to make sure you can't just quietly shuffle money around without paying your fair share. Know the rule, respect the rule, and then decide intelligently whether the strategy still makes sense for your specific situation. If this video opened your eyes or made you realize you need to go back and look at your old tax returns, drop a comment below and let me know. I read every single one, and if you know someone who's been bragging about their tax-free backdoor Roth without knowing any of this, do them a favor and send them this video. You might just save them a very unpleasant surprise come April. I'm Dr. James, your money advisor. Stay sharp, stay informed, and I'll see you in the next one.